Hello students, welcome to the lecture on financial system analysis, and after this lecture we will be able to learn the following objectives. Explain the concept and objectives of financial statement analysis, define the types of financial analysis statement, discuss the comparative financial statements, explain the trend analysis, discuss the ratio analysis, explain the DuPont analysis. Let us start with what financial statement is. Financial statement is the process of understanding the risk and profitability of a firm through analysis of reported financial information, particularly annual and quarterly reports. Financial analysis is the selection, evaluation, and interpretation of financial data along with other pertinent information to assist in investment and financial decision making. Financial analysis may be used internally to evaluate issues such as employee performance, the efficiency of operations, and credit policies, and externally to evaluate potential investment and the creditworthiness of borrowers, among other things. The analysis draws the financial data needed in financial analysis from many sources. Primary source is the data provided by the company itself in its annual report and required disclosure. The annual report comprises the income statement, balance sheet, and the statement of cash flows, as well as footnotes to these statements. We know business is mainly concerned with the financial activities. In order to ascertain the financial status of the business, every enterprise prepares certain statements known as financial statements. Financial statements are mainly prepared for decision-making purposes, but the information as is provided in the financial statement is not adequately helpful in drawing a meaningful conclusion. Thus, an effective analysis and interpretation of financial statement is required. Analysis means establishing a meaningful relation between various items of the two financial statements with each other in such a way that a conclusion is drawn. By financial statement, we mean two statements: profit and loss account or income statement, balance sheet or position statement. These are prepared at the end of a given period of time. They are the indicators of profitability and financial soundness of the business concerned. The term financial analysis is also known as analysis and interpretation of financial statement. It refers to the establishing meaningful relationship between various items of the two financial statement, that is income statement and position statement. It determines financial strength and weaknesses of the firm. Analysis of financial statement is an attempt to assess the efficiency and performance of an enterprise. Thus, the analysis and interpretation of financial statement is very essential to measure the efficiency, profitability, financial soundness, and future prospect of the business units. Financial analysis serves the following purposes: measuring the profitability, indicating the trend of achievements, assessing the growth potential of the business, comparative position in relation to other firms, assess overall financial strength, assess solvency of the firm. Let me tell you about different types of financial statements. There are different types of financial statements. Financial statements are required to be audited by authentic, efficient audit firms to avoid manipulation of numbers. Statements are usually audited by the accounting firms after a thorough study of the company records. The accounting and the audit firms make sure that the company is obeying and operating as per norms laid down by the generally accepted accounting principle, or GAAP. Basically, there are four different types of financial statement. Different types of financial statements indicate the different activities occurring in a particular business house. Balance sheet. The balance sheet provides an insight into the financial status of a company at a particular time. The balance sheet type of financial statement is different in comparison to the other types of financial statements. Other financial statements are prepared by taking into account the financial health of the company over a considerable span of time. Income statement. also known as the P&L statement or the profit and loss statement. This statement ascertains the profit and loss of any business. This can be again of two types: single step income statement, multi-step income statement. Statement of retained earnings. This financial statement denotes alteration in these rights of equities in any business. Statement of cash flow or cash flow statement. This statement highlights flow of cash over a period of time. The cash flow may be from investment activities, operation or financial activities.
Ria is a proprietor of Ria Collections who is into manufacturing and selling of fashionable footwear. She takes a store on rent. First, she buys furniture and then she acquires the stock. Now the store is decorated and set. She starts her business. The shoppers keep pouring in and the sales are up. Ria is really happy counting money. With sales being up, Ria feels the need for a company car. 3 months have passed and Ria needs to know how's the business doing, and she gets all the answers in the balance sheet. Ria shares the concepts of balance sheet with you so that the concept becomes clear. Assets, liabilities and capital. Machine, furniture, leather, car, cash, fixed deposits, receivables, prepaid expenses. Capital is owner's fund and bank loan. Liability is payables. Assets is equal to liabilities plus capital.
Now let us take an example of 12 transactions of one quarter. First example is on 2nd January, Ria receives rupees 50,000 from her father to start her business. Now we will pass a journal entry of cash bank account debit of 50,000 and capital account will be credited by 50,000. This is the journal entry what we will be passing in the books. Now this journal entry will be posted in the balance sheet as asset side. Cash bank will show 50,000 as a balance and capital account will be credited by 50,000. Assets and liability will get tallied by 50,000 and balance sheet will get tallied.
What does comparative study of financial statement means? Comparative study of financial statement is the comparison of the financial statement of the business with the financial statement. It enables identification of weak points and applying corrective measures. Practically, two financial statements are prepared in comparative form for analysis purposes. Let us begin discussion of comparative balance sheet. The comparative balance sheet shows the different assets and liabilities of the firm on different dates to make comparison of balances from one date to another. The comparative balance sheet has two columns for the data of original balance sheets. A third column is used to show change in figures. The fourth column may be added for giving percentages of increase or decrease. While interpreting comparative balance sheet, the interpreter is expected to study the following aspects: current financial position and liquidity position, long-term financial position, profitability of the concern. For studying current financial position or liquidity position of a concern, one should examine the working capital in both the years. Working capital is the excess of current assets over current liabilities. For studying the long-term financial position of the concern, one should examine the changes in fixed asset, long-term liabilities and capital. The next aspect to be studied in a comparative balance sheet is the profitability of the concern. The study of increase or decrease in profit will help the interpreter to observe whether the profitability has improved or not. Now we will discuss comparative income statement. The income statement provides a result of the operations of a business. This statement traditionally is known as trading and profit and loss account. Important components of income statement are net sales, cost of goods sold, selling expenses, office expenses, etc. The comparative income statement gives an idea of the progress of a business over a period of time. The changes in money value and percentage can be determined to analyze the profitability of the business. like comparative balance sheet, income statement also has 4 columns. The first 2 columns are shown figures of various items for 2 years. Third and fourth columns are used to show increase or decrease in figures in absolute amount and percentages respectively. The analysis and interpretation of income statement will involve the following. The increase or decrease in sales should be compared with the increase or decrease in cost of goods sold. To study the operating profits, the increase or decrease in net profit is calculated. That will give an idea about the overall profitability of the concern. Now coming to the common size income statements and balance sheets. The common size statements are shown in analytical percentages. The figures of these statements are shown as percentages of total assets, total liabilities and total sales respectively. Take the example of balance sheet. The total assets are taken as 100 and different assets are expressed as a percentage of the total. Similarly, various liabilities are taken as a part of total liabilities. Common size balance sheet. A statement where balance sheet items are expressed in the ratio of each asset to total assets and the ratio of each liability is expressed in the ratio of total liabilities is called common size balance sheet. Thus, a common size statement may be prepared in the following way. The total assets or liabilities are taken as 100. The individual assets are expressed as a percentage of total assets, that is 100, and different liabilities are calculated in relation to total liabilities. Common size income statement. The items in income statement can be shown as percentages of sales to show the relation of each item to sales. The ratio is an arithmetical relationship between two numericals. It is expressed as a proportion or a fraction or in percentage or in terms of number of times. For example, expenses are 70% of sales, or sales of current year are 4 times more than that of the last year. Net profits are 1/10 of the capital employed, etc. These accounting ratios are ratios formed out of figures taken from financial statements. These are calculated by placing 2 figures taken from financial statements in the form of ratio. They are tools in the hands of users and help the management in taking decision. Analyzing financial statement from various aspects of a business through the techniques of accounting ratios is called ratio analysis. Ratio analysis is an important technique of financial analysis. It is a means for judging the financial health of a business enterprise. It determines and interprets the liquidity, solvency, profitability, etc. of a business enterprise. It becomes simple to understand various figures in the financial statements through the use of different ratios. For example, a profit of INR 20,000 may not sound very impressive, but if it is earned with the help of a capital of INR 20,000, it becomes easy to say that the profit is reasonably good by stating that it is 100% of the capital. Accounting ratios simplify, summarize and systematize the accounting figures presented in financial statements. Helpful in comparative study with the help of ratio analysis, comparison of profitability and financial soundness can be made between one firm and another in the same industry. Similarly, comparison of current year figures can also be made with those with the help of ratio analysis, and if some weak points are located, remedial measures are taken to correct them. Coming to the advantages and uses of ratio analysis. There are various groups of people who are interested in analysis of financial position of a company. They use the ratio analysis to work out a particular financial characteristic of the company in which they are interested. Ratio analysis helps the various groups in the following manner to work out the profitability. Accounting ratio help to measure the profitability of the business by calculating the various profitability ratios. It helps the management to know about the earning capacity of the business concerned. In this way, profitability ratios show the actual performance of the business. To work out the solvency. With the help of solvency ratios, solvency of the company can be measured. These ratios show the relationship between the liabilities and assets in case external liabilities are more than that of the assets of the company, it shows the unsound position of the business. In this case, the business has to make it possible to repay its loans. Helpful in analysis of financial statement. Ratio analysis helps outsiders just like creditors, shareholders, debenture holders, bankers to know about the profitability and ability of the company to pay them interest and dividend, etc. Helpful in comparative analysis of the performance. With the help of ratio analysis, a company may have comparative study of its performance. In this way, company comes to know about its weak point and be able to improve them. To simplify the accounting information, accounting ratios are very useful as they briefly summarize the result of detailed and complicated computation to work out the operating efficiency. Ratio analysis helps to work out the operating efficiency of the company with the help of various turnover ratios. All turnover ratios are worked out to evaluate the performance of the business in utilizing the resources to work out short-term financial position. Ratio analysis helps to work out the short-term financial position of the company with the help of liquidity ratios. In case short-term financial position is not healthy, efforts are made to improve it. Helpful for forecasting purposes. Accounting ratios indicate the trend of the business. The trend is useful for estimating future. With the help of ratios, estimates for future can be made. In this way, these ratios provide the basic for preparing budgets and also determine future line of action. Limitation of ratio analysis. In spite of many advantages, there are certain limitations of the ratio analysis techniques and they should be kept in mind while using them in interpreting financial statements. The following are the main limitations of accounting ratios. Limited comparability. Different firms apply different accounting policies. Therefore, the ratio of one firm cannot always be compared with the ratio of other firm. Some firms may value the closing stock on LIFO basic, while some other firms may value on FIFO basic. Similarly, there may be difference in providing depreciation of fixed assets or certain of provisions for doubtful debts, etc. False result. Accounting ratios are based on data drawn from accounting records. In case that data is correct, then only the ratios will be correct. For example, valuation of stock is based on very high price. Profits of the concern will be inflated and it will indicate a wrong financial position. The data therefore must be absolutely correct. Effect of price level changes. Price level changes often make the comparison of figures difficult over a period of time. Changes in price affect the cost of production, sales, and also the value of assets. Therefore, it is necessary to make proper adjustment for price level changes before any comparison. Qualitative factors are ignored. Ratio analysis is a technique of quantitative analysis and thus ignores qualitative factors which may be important in decision making. For example, average collection period may be equal to standard credit period, but some debtors may be in the list of doubtful debts which is not disclosed by ratio analysis. Effect of window dressing. In order to cover up their bad financial position, some companies resort to window dressing. They may record the accounting data according to the convenience to show the financial position of the company in a better way. Costly technique. Ratio analysis is a costly technique and can be used by big business houses. Small business units are not able to afford it. Misleading result. In the absence of absolute data, the result may be misleading. For example, the gross profit of two firms is 25%, whereas the profit earned by one is just INR 5,000 and sales are INR 20,000 and profit earned by the other one is INR 10 lakhs and sales are INR 40 lakhs. Even the profitability of the two firms is same, but the magnitude of their business is quite different. Absence of standard university accepted terminology. There are no standard ratios which are universally accepted for comparison purposes. As such, the significance of ratio analysis technique is reduced. The dew point analysis is an approach that breaks down ROE, return on equity, into a function of 3 or 5 ratios that helps to see the impact of each ratio on ROE. If accounting ratios are calculated for a number of years, they will reveal the trend of cost, sales, profits and other important facts. Such trends are useful for planning. For example, if sales of a firm during this year are INR 10 lakhs and average amount of stocked cap during the year is 3 lakh, that is 30% of sales, and the firm wishes to increase sales next year to INR 15 lakh, it must be ready to keep a stock of INR 4.5 lakh, that is 30% of 15 lakh. Now in the end, let us summarize what we have learned in this lecture. Financial statement is a process of understanding the risk and profitability of a firm through analysis of reported financial information, particularly annual and quarterly reports. 4 types of financial statements are balance sheet, income statement, statement of retained earnings, cash flow statement. The comparative balance sheet shows the different assets and liabilities of the firm on different dates to make comparison of balances from one date to another. Comparative income statement gives an idea of the progress of a business over a period of time. A statement where balance sheet items are expressed in the ratio of each asset to total assets and the ratio of each liability is expressed in the ratio of total liabilities is called common size balance sheet. The items in income statement can be shown as percentages of sale to show the relationship of each items to sales. Ratio analysis helps the various groups in the following manner to work out profitability, to work out solvency, helps in analysis of financial statement, helpful in comparative. Limitation of ratio analysis are limited comparability, false result, effect of price level changes, qualitative factors are ignored, effects of window dressing, costly technique, misleading result. The dew point analysis is an approach that breaks down raw return on equity into a function of 3 or 5 ratios that helps to see the impact of each ratio on raw.